A very good evening, friends. I'm Sanjeev Singhal, Central Council Member and Chairman Auditing and Assurance Standard Board and Chairman Sustainability Reporting Standard Board. I welcome you to this 48th program of the AASB in this council year. Today's topic is audit sampling, test of control, and substantive procedure. Friends, as you know that in this council year, we have started a series of seminars and webinars on various topics. And so far, we have covered all the auditing standards. And now we also covered CARO. We covered auditing aspects in Schedule 3. We covered the interplay of CARO and Schedule 3. And now shortly, we'll be moving to the an overall 360-degree view of the audit of the various items in the financial statement, which will cover not only the requirement of the auditing standard, but also CARO, Schedule 3, and the related accounting standards and Ind AS related auditing requirement as well. And we have received a lot of support from all of you. The presence of the esteemed members has been overwhelming. More than 1 lakh members have already attended of the AASB in this council year, and we look forward for your continued patronage. Friends, I'm very happy to share with you today. Keynote speaker is my chairman of the committee for member in public service and entrepreneurship, and the learned council member who has served the profession in branch, regional council, and the central council for 27 years. He's no other than our own CA Babu Ibrahim. We, with love and affection, we call him Babu Bhai. He's a first-class commerce graduate from the University of Kerala. He's a fellow chartered accountant with 35 years of experience, and out of which 27 years have been given to our beloved institute. He's also a certified information systems auditor. He holds a postgraduate diploma in information system audit. He's also an insolvency professional. He holds a certificate in forensic accounting and fraud detection. He's been the chairman of the PDC, chairman of the committee for member in entrepreneurship and public service for a very long period of time, chairman of the expert advisory committee, chairman of the research committee, financial reporting review board, board of studies, member of the disciplinary committee. He was ARC in 2010-11, and he's been a member of the Public Sector Financial Management Committee of CAPA for 21 to 25. He's been a director, Kerala State Industrial Development Corporation from 21 onwards. He's the chairman of the Committee on Education Training and CPD of SAFA for 2017-18, president of the Cochin chapter of the ISA-CA of USA from 2011 to 15. He's been the director of State Bank of India on the Trivandrum Local Board 2008 to 2011, past chairman of the Ernakulam branch of SIRC of ICI in 1998-99, founder president of All Kerala Chartered Accountant Association, and his international exposure has been a speaker at the Global Leadership Conference of IAS-ACA at the Las Vegas, USA, and also in Japan. He's been a regular columnist in Malayalam Manorama, and he's been a founder editorial board member of the New Age of the first Malayalam Business Daily. And of course, thousands and thousands of seminars he has addressed. Besides, he takes very active part in the social activities. He's a former treasurer of Bharatiya Vidya Bhavan, Kochi Kendra, founder trustee of Sampurna, School for Children with Special Need, past president of the Rotary Club of Kochi, and past district treasurer, Rotary International District 3200, to mention a few. A great personality, a great contributor in the council. I had the pleasure of working with him for 3 years in the council, and one of the most lovable council member which we have. So we're thankful to you, Babu Bhai, that you've taken out time for this very important cause. And he's joined by 2 speakers, CA Nilanjan Paul and CA Monish Sharma, who are both members with more than 15 years of experience and brings substantial knowledge and the practical experience on the table. So I'm sure that the members would have very a very good experience, and they will be able to learn how to do the audit sampling, because audit works on sampling, and how to apply the test of control and the substantive procedure. Before I invite both the learned speakers, may I now request Babu Bhai to give his keynote address. Thank you, and over to you, Babu Bhai.
Thank you, my very dear friend and former colleague in the council, especially for the wonderful introduction and the very nice words about me, and also for giving me this opportunity to be part with all of you today in this wonderful evening. Undoubtedly, it is a great honor and privilege to be part of the virtual CPE meeting organized by the WASB of the ICAI on the topic on audit sampling, test of controls, and substantive procedures. I should congratulate Sanjeev Singhal, the chairman of the WASB, and the team for organizing a series of webinars. I understand this is a 48 such chain seminar, and they have an ambitious target of 250 such seminars during this year. Besides physical programs which being organized at the regional council level and at the branches, I can see the passion in the chairman, because he himself is one of the acclaimed audit and assurance professional in this country, and I think his passion and his knowledge and expertise in this field, I think the best service one can do is to disseminate the knowledge and share the knowledge one have. And I think I'm extremely thankful and should congratulate the chairman for taking this wonderful initiative in reaching out to the membership, because auditing is the core of our profession. And if the quality is judged, I think the primarily it is based on the level of quality of the assurance, because it is a trust which we convey to the public and to the other stakeholders. The very distinguished chairman of the WASB is one among the two doctors in the council whom we used to look upon for all the solutions of the ills of the profession. And I think he continues to be like that. He has got unmatched experience and expertise in today's topic of discussion. And many may consider him as a walking encyclopedia and audit and assurance and related matters, besides his expertise on IFRS, Ind AS, and standards on auditing. And I'm thankful to you, Chairman, once again for giving me this opportunities. And also today we have been joined by two distinguished and eminent experts, Niranjan and Monisha, who will enlighten us on this topic. As far as today's presentation is concerned, the selection of the topics seems largely enthralling for all stakeholders connected to the audit and assurance, and also might give us a refreshed outlook towards the concepts, relevance, and its practical applicability. As far as audit sampling is concerned, probably this is one of the concepts which is gradually becoming irrelevant due to the advent of robust audit tools, which is capable of testing the entire data and raise red flags, change the way we do audit today. However, whether one resorts to sampling or otherwise, one must ensure compliance with SA 530 on audit sampling, which envisages that the auditor should have a reasonable basis to draw the conclusions about the population. All of us will agree that the basic purpose of audit is to ensure that there is no material misstatement in the financial statement, so that it gives a true and fair view. Towards this, the auditor is required to obtain sufficient and appropriate audit evidence. The auditor designs the audit procedures based on the risk perception, whether it is inherent risk or the control risk. It may, in any case, he has to first assess the control environment, though what is generally called as compliance procedures or compliance testing or test of controls. Whenever there is a strong internal control mechanism, like in the case of banks, Where an auditor is satisfied, he reduces the substantive audit procedures, which includes the test of details and the analytical procedures. Therefore, a combined approach using both test of controls and substantive procedures may be considered as a most effective approach. Based on the results of the test of controls, one has to determine the nature, the timing, the extent of substantive procedures. It is simple. If the internal control is weak, you are bound to increase the substantive testing and vice versa. I am sure today's expositions will add a further conceptual clarity on the audit sampling, test of controls, and substantive testing, and its role and relevance in framing the audit opinion on the financial statements. Wish you a great learning and rewarding session for next 2 hours. I once again thank my good friend and former colleague in the council, Dr. Sanjeev Singhal, for giving me this opportunity to be part of today's deliberations. Thank you very much. Over to the chairman.
Thank you, Babu Bhai. Thank you. The authority about the inherent risk and the other attributes is really remarkable. That speaks the diverse topics on which you as a council member have developed the expertise through the deliberations that take place in the council. Many thanks, Babu Bhai, once again.
Thank you, Chairman.
Thank you for your kind presence. And now may I request our two learned speakers, Monish and Nilanjan, who would like to speak first, Manish or Nilanjan?
I think
Nilanjan.
Yeah.
So I invite you, Nilanjan, to start your deliberation first.
thank you, Sanjeev sir. I think it's a personal privilege and an honor to interact with many fellow professionals through this wonderful forum which ICI has established. I look forward for a engaging and a more interactive discussion with various members. I'm happy to
sure.
learn.
And as of now, more than 1,850 members
Sure.
have already joined, and I'm sure that very soon this number will increase. Please
Sure.
go on, carry on.
Yeah. So with this, I will start my presentation and I will share my screen. Okay, so the topic for today's discussion, as we know, is audit sampling. Audit sampling is covered in the auditing standard 530, which gives a very detailed guidance and lays the overall framework when the auditor, in its judgment, decides to use a sampling technique. So as we all know, sampling is very fundamental and core to any audit engagement. And in today's scenario, considering the information of, and the volume of data that we have, audit sampling is always resorted as one of the ways to enhance audit efficiency as well as ensure audit quality. So in a nutshell, if I have to explain what is meant by an audit sampling is a procedure where the auditor decides to test items less than 100%. So that means he doesn't want to audit the entire set of population, but he wants to do a selective testing of certain items, and those items are identified based on a prescribed method. Now, the benefit of this particular approach is that it removes ad hocism. What it means is that the auditor uses a prescribed and a reasonably strong framework to choose samples from the entire set of population. And by testing these limited number of items, the auditor then draws a conclusion on the appropriateness of the entire balance, right? And by doing this activity, auditor then finally concludes on the overall opinion of the financial statements. So this, as we all know, is a very key procedure when we are trying to audit the financial statements. The auditing sample also provides a very strong scientific and foundation and a logical foundation and credence to test check basis which the auditor follows. Generally, in an audit, we do follow test check, and audit sampling method or procedure is somehow complementing to this entire approach. What I would like to also highlight is that audit sampling can also be used to verify or to carry out compliance procedures and substantive procedures both. So by compliance procedures, it is the review and evaluation of effectiveness of internal controls. Substantive procedures is more to do with the audit or completeness or accuracy of the validity of the data involved. Broadly, the standards on auditing states that there are two basic sampling categories, which could be statistical or which could be non-statistical, and we'll be covering some of them in our subsequent discussions. As always, in any particular approach, the audit sampling also has certain limitations, and I would be covering them towards the end of the session. So that's what, in a nutshell, what auditing sampling is, and which again is to test a limited number of items as compared to the entire population. Now, what are the benefits of audit sampling, right? So it obviously the most important benefit of audit sampling is that it reduces significant efforts and reduces incurrence of significant cost. So imagine if in a financial statement audit, I will have thousands and thousands of line items. If an auditor decides to validate the entire set of transaction, there would obviously a significant amount of cost and effort that will be involved. The sampling technique or the sampling approach provides a balance, and it helps the auditors to be more efficient as well as focus the audit procedures towards a particular set of transaction. It establishes objectivity and credibility to the audit results and gives more meaning to the audit approach. What I would also like to highlight is that there is no statutory requirement, neither in any of the governing statute or in the auditing standards, which mandates the use of audit sampling. It is left to the judgment of the auditor based on the facts and circumstances. The auditor decides whether to use the sampling techniques, or he or she would decide or like to verify the entire population. Ultimately, the objective of sampling and the audit as a whole is to have is to enable the auditor to express an audit opinion on the financial statements. In this slide, I have just given certain extracts which complements the standards on auditing 530. So if you would go to the standards on auditing 500, which also reiterates that the auditor can either decide to test 100%, or they can also apply sampling technique. Now, when this sampling technique is applied, the auditing standard 500 on audit evidence clearly states that when the items are being selected for testing, the auditor is required to perform sufficient procedures to ensure the relevance and reliability of the information of audit evidence, and also to ensure sufficiency, because unless the auditor has a comfort on the underlying data, there is a likely chance that the conclusion which the auditor would draw would be incorrect. Again, the standards on auditing 500 reiterates that sampling could be used for test of controls as well as test of details. It is also possible that sampling is not the only or the sole audit procedure. It could also be performed in combination of other procedures, so that the risk of material misstatement is reduced to an acceptable level. Moving on, in this slide, I have tried to highlight what could be the possible steps which the auditor would be expected to carry out when he or she decides to follow the sampling approach. So if you would look at this slide, the sampling approach would primarily involve 5 steps, beginning with sample design, the size of this sample, selection of item for testing. This stage I would call is the planning stage, wherein the auditor decides the overall sampling strategy and the plan on carrying out the sampling techniques. The next step would be performing the audit procedures on the underlying data as well as on the samples being identified. Third step would be to evaluate the nature and cause of deviations or misstatements, if any. The next logical step would be that the auditor should project those deviations or misstatements on the entire population. And finally, at the last instance, the auditor would evaluate the result of audit sampling on the particular account caption or on the particular internal control. What I would also like to highlight is that when the auditor is designing the entire sampling plan, the sampling plan should be consistent with the audit objective and the testing programs. So if let's say the auditor is deciding to verify the existence of revenue, the sampling plan and the sampling strategy should follow suit. It should work in a more complementary manner so that it helps the auditor to reach an overall conclusion. Sorry. So let's discuss on the first step, which is basically the sample design. So here, when the sample is being designed, the auditor should consider the purpose of the audit procedure and the characteristics of the population from which the sample is to be drawn. So again, if we continue with the example on revenue, the auditor might look at the entire revenue transactions for the year and verify whether the entire set of population have certain characteristics. For example, there could be revenue from multiple sources, for example, from government agencies, from distributors, or from retail. So the auditor should evaluate that data and based on the characteristics of the transactions in that particular list of transaction, they should define the overall sampling strategy. Now, when the sampling strategy is being evaluated, the auditor should consider the significance of sample to an overall audit objective. So if the objective is to evaluate, let's say, existence of revenue, the auditor should also decide how much or how many samples he should be considering so as to have a conclusion on the account balance. If there is a specific purpose which the auditor wants to achieve, that would also influence the overall sampling plan. For example, if in the previous experience of the auditor there has been cutoff issues, auditor should consider when they are deciding the sampling plan for the current year. It could also be possible that when the auditor is deciding the sampling plan, there could be other complementary procedures which the auditor would have planned in its overall audit strategy. So if the auditor is planning to perform such additional or alternate procedure, so that should also be taken into consideration, because that will also impact the efficiency part of the audit size. Obviously, the auditor would not like to have a duplication in the audit procedures. Lastly, but most important, the auditor might like to consider the knowledge and the area under consideration. So if the auditor has prior experience in the particular audit or in that particular industry, that could be a very insightful aspect which the auditor might consider when designing the overall sampling plan. Now, the auditing standard 530 is a principle-based standard, and it gives us on an overall basis what could be the probable ways in which the sampling can be done. So the standards states two categories. So one is stratification and the other is value weighted method. So in a stratification, what happens is that if if the population is large, then the standards suggest that you segregate the population into various categories. So, for example, in our revenue example, let's say I had revenue from government parties, or I had revenue from retail, or revenue from distributors. To have a more meaningful and good audit strategy, the standard permits to segregate the data into various classes. Now, the benefit of this particular approach is that it focuses the auditor's attention towards the particular class. Okay, so it is likely that through this approach, the items which have a greatest potential misstatements, they are expected to be get covered when the auditor is using the stratification approach. Next, the auditor might consider to use value weighted approach. Here, instead of segregating the data into various characteristics or categories, the auditor might like to verify samples above a particular threshold. Let's say I decide that I would verify samples which are more than 1 lakh or a crore. So the benefit of this approach is that the audit effort is directed towards a larger volume, and because of this, there is a greater chance of selection of larger value items, and this will again reduce the number of samples. Broadly, the audit tools or the audit sampling methods are primarily based on either of these two concepts. Okay, so now when the auditor is also designing the sample, the auditor should also have a clear understanding what would constitute a deviation or a misstatement. So let's say the invoice of a particular sales transaction is not available. Will that be constituting a deviation in the mind of the auditor? Or is it that I don't have appropriate cutoff documents? Will that constitute a deviation? So again, a very fact specific and entity specific evaluation which the auditor would need to do. The way we identify materiality for the entire financial statements, while designing the entire sampling plan, the auditor is also required to determine the tolerable misstatement. What it means is that if there are misstatements which the auditor identifies, and the cumulative effect of that misstatement exceeds the tolerable amount, then the auditor would need to consider these misstatements when they are forming the entire true and fair view on the financial statements. Normally, in my experience, what I have seen is that while determining the tolerable misstatement, the amount is same or lower than the performance materiality. That again makes sense because I would not expect the auditor to have a higher tolerable misstatement than the performance materiality. Again, the standard on auditing states that whether the auditor would be using statistical or non-statistical sampling approach is purely an auditor's judgment and based on facts and circumstances. So in this slide, I have just highlighted what could be those possible nuances on certain commonly audited financial statement captions when the auditor is designing the audit or the sampling strategy. For example, in case of inventories, the auditor might like to verify inventories which have negative in value, or inventory items that have not moved from the last 1 year or so, or inventory items which has not which do not have any recorded location. Similarly, from the verification of property, plant and equipment, the auditor might like to verify items which have a negative net block, or items of PPE which are duplicate, or PPE balances which are above a particular threshold. If I talk about the nuances of a P&L item, for example, salary and wages, the auditor might like to verify duplicate employees, or employees where the pay rates exceeds the average pay rate of the entity. So again, these are only illustrative considerations which the auditor might apply. But again, the message here is that when the auditing sample is being decided or the plan is being formulated, we need to take into consideration those nuances that we have gathered in our risk management or planning discussions or on our previous experience on that particular client or industry. Okay, now after we have decided the overall sampling strategy, the next step would be to decide the sample size. Here, the standard on auditing is very clear to say that the sample size should be found out as such, so that the sampling risk is reduced to an acceptably low level. If I have to explain this line a bit further, uh, it is possible that if the auditor decides to verify the entire population, the auditor might reach a different outcome. So the standards on auditing very clearly specifies that since we are using a test check approach or we're using a selected uh, samples, it is possible that there could be certain misstatements which may not get uh, get to our attention. So this particular risk is mitigated by determination of appropriate sample size. So if the auditor, based on the facts of that particular case, wants to have a higher comfort level or a higher level of assurance on a particular financial statement caption or internal control, that will obviously push for a higher number of samples. Whereas if the auditor uh, has overall comfort on the internal controls, then obviously that will help in reducing the sample size. Again, the sample size can be determined based on statistically used formula, or it can also be found out based on exercise of professional judgment. So in this slide, I have just highlighted what could be the factors that would affect the determination of sample size. So for example, if the inherent risk of assessment is lower and the auditor intends to rely on control, then obviously the sample size is expected to be lower. Whereas to the contrary, if the auditor do not want to rely on control, or there are higher inherent risk, for example, there is a risk of fraud in a particular account caption, it will again push for a higher or a larger number of sample size. Tolerable misstatement, if the auditor fixes a higher percentage or a higher threshold of tolerable misstatement, this will obviously have an inverse relationship with the number of samples. Higher the tolerable threshold for misstatement, the lower would be the sample size. Similarly, if the auditor is planning to use audit sampling in combination with other substantive procedures, then this would lead to a reduction in the audit samples, because auditor would obviously be performing other complementary procedures. Whereas if that is not the case, where the auditor is relying primarily on the samples, then the auditor might like to have a higher number of samples. Similarly, if the misstatements are expected to be higher, then it would again shoot up the number of samples. Whereas if in the auditor's assessment the misstatement is lower, then the sample size would be lesser in that case. The next step in the determination of sample is the selection of sampling method. The standard is very categoric to say that when these samples are being selected, it should be selected in such a way that each and every sampling unit in the population has a chance of selection. So in our revenue example, let's say I have thousands and thousands of items. When I am selecting, or the auditor is selecting the sample, each and every item of that list of transactions should be given a chance. It can't be that the samples are being selected on an arbitrary basis. If that is the case, then it is likely that the conclusion which the auditor would draw would be unbiased. Sorry, would be biased, and the conclusion would not be appropriate. So the standards on auditing very categorically states that while selecting the sampling method, the sample selected should be such that it is representative of the entire population, right? Again, whether to use a statistical basis or a non-statistical basis is again dependent on the judgment of the auditor. So in this slide, I have highlighted what could be the principal sampling methods. So if you would look at in this slide, there is a method called random selection, where the auditor from the entire population chooses on a random basis the samples that it intends to verify. Another method is to have a systematic selection. This is where the auditor verifies the sample based on a specific interval. Let's say it decides that I would verify the 50th item at every interval, and that would be a basis of selection. The most commonly used sampling method, which I have seen, is the monetary sample unit, where the sample size, selection, and the evaluation result is in a conclusion to monetary amount. So here I use the monetary thresholds, which I've used for materiality. I consider the tolerable misstatement thresholds. I use the level of confidence that I have in the particular account caption. Based on a combination of all these attributes, I use the particular method when I am deriving the samples. One of the non-statistical technique which I have highlighted for discussion is a haphazard selection. The standard acknowledges that there could be situation where there are very fact specific or entity specific information. For example, there are particular risk factors that are associated with a particular account caption. Those risks may not be properly addressed if the other methods of samplings are used. So these standards on auditing permit to use a non-statistical sampling technique, which is a haphazard basis of selection. Now, after the auditor has decided the audit or the sampling technique, the next step is to decide the audit procedures. To begin with, the first step what the auditor should do is that they should perform sufficient appropriate evidence to verify that the population from which audit sample is drawn is complete. So let's say we are trying to verify the data which would be sent to actuary for the purpose of employee benefits. Then it is important that the auditor reconciles the data from the financial reporting framework, maybe from the payroll register or from the employee register, so as to ensure that the data that is being used is complete. Similarly, if you are trying to verify the aging of a trade receivable, it is important that we cross-check the data provided to the auditor with the amount sitting in the financial statement. If there is a difference, then the auditor should obtain specific reasons and the specific reconciliation from the management prior to performing any audit procedures. Again, the audit procedures the auditor which would perform would be appropriate to the purpose on which the item is selected. So for example, the auditor is planning to verify the aging of trade receivable. It should pick up the samples which might not have moved maybe for a year or so, and then perform audit procedures. Now, on those audit procedures, the auditor should verify what would be those procedures. Will I look at communications that the entity would have made to the customer, or uh, uh, or whether there are ongoing reconciliations which the auditor should consider. So again, based on the specific facts, the auditor would need to frame the audited procedures that are appropriate for that particular purpose. Now, it could also be possible that the sample which the auditor would have selected, uh, it is a sample for which no evidence is available. So if I can explain this with an example, let's say we are verifying the payments that I have made to a particular vendor. The sample that I would have picked up could be a situation where the check has been cancelled. So in that case, the standard on auditing 530 requires the auditor to perform or identify a replacement item and test that replacement item, right? Uh, uh, the auditor would also need to perform suitable alternate procedures. For example, where we have sent out confirmations and the response towards those confirmation had not been up to the mark, then the auditor might even think of looking at subsequent receipts as a alternative procedures. So in a nutshell, what I am trying to highlight is that while performing audit procedures, the moot point is to ensure completeness and accuracy of the underlying data. The auditor would need to also plan for alternate procedures if the procedures from the primary audit procedures are not giving the auditor the required level of comfort. If the auditor is unable to apply audit procedures or alternate procedure, the auditor should treat them as a deviation from the prescribed control, in where the auditor is testing the test of controls, or as a misstatement when they are verifying the test of details. Now, after we have performed the audit procedure, the next step would be to evaluate the nature and cause of deviations and misstatement. Here, the auditor is required to investigate the nature and cause of deviation of misstatement identified and evaluate the possible effect on the overall audit strategy. So in our example of revenue, let's say there is a issue in cutoff and the auditor has concluded that there are misstatements. The auditor would need to see to what extent the financial statement caption is being affected. If the caption is affected materially, then whether there are other qualitative aspects on those misstatements. For example, whether the misstatement has a common feature with other misstatements, whether the misstatement is the result of an error or it potentially indicates a fraud, whether the misstatement is results of a misunderstanding of instructions or negligence, or whether what are the possible effect of the misstatement in the other areas of audit. So when a misstatement is identified, the auditor would need to evaluate the consequential implications, especially whether the misstatements are indicative of a fraud, or whether these or the outcome of the sampling procedure would need to be factored when the auditor is performing the other audit procedures. Normally, the sampling results are considered in conjunction with other tests and evidences prior to making a final conclusion, right? Because sampling on its own may not provide the desired level of comfort. So the auditor would anyway have framed supporting or alternate audit procedures. So when the auditor is trying to evaluate the deviation or the misstatement, both the primary as well as the alternate procedures should be used in evaluating the deviations or misstatements. After the deviations have been identified, the next logical step would be to project the misstatements. So here, when the auditor is, let's say, performing test of details, the auditor should project the misstatement on the overall financial statement caption to obtain a broader view of the scale of misstatement. So if let's say there is a deviation on the balance of trade receivable, the auditor would need to project that misstatement as to see to what extent the particular amount is misstated, and then the auditor should also verify whether the misstatement is material or not. So if the misstatement is an anomaly, this obviously should be excluded from projecting the misstatement, simply because the conclusion which the auditor might draw from a wrong information would not be incorrect. Whereas if there is a misstatement when the auditor has identified a deviation in test of control, then what happens is that the auditor doesn't need to project the misstatement. Under the standard on auditing, they have very clearly specified that the moment there is a deviation, it is expected that there is a deviation in the internal control itself. So unlike the test of details where the deviation is projected to the entire financial statement caption, here if there is a deviation in the control, uh, it do not require any projection. The control itself is expected to be deficient. So now let's understand the projection of misstatement through an example. So in the slide, if you would see, the auditor has identified 3 misstatements. The book value is 100 and the misstatement is of 13 rupees. Similarly, there is a book value of an item of 1,500 and there is a misstatement of 150. The third item is of book value of rupees 500 and there is a misstatement of 75. If you would look closely in this data, there is a fairly constant percentage of misstatement. Okay, and that misstatement would be ranging around 10 to 50 to 15% of the individual item. So basis the outcome of the individual items, the auditor might conclude that the item on which the sample has been drawn is misstated to the extent of 10 to 15%. So that's one of the way based on which the auditor can project the misstatement on the entire financial statement caption. Okay, now the next step would be to evaluate the results. After the projection of a misstatement, the auditor is required to evaluate the results of the sample and whether the use of audit sample has provided a reasonable basis for conclusion. So again, where there is a misstatement in case of a test of detail and the misstatement exceeds the tolerable misstatement threshold, then the auditor would conclude that this sample doesn't provide a reasonable basis for conclusion. In that case, the auditor would need to request the management to look at those misstatements and adjust the financial statements. Where the auditor has experienced a very high level of misstatement, then uh, it is possible that the class of transaction is materially misstated, right? Similarly, in case of a test of control, if the auditor expects high sample deviation rate, that may lead to an increase in the assessed risk of material misstatement. So in a nutshell, what I'm trying to explain is that if there are misstatements, the auditor is supposed to look at the impact of misstatement on the entire financial statement caption and also on the overall internal control framework. If the audit sample do not provide a reasonable basis for conclusion, the auditor may request the management to investigate the misstatements and the potential for further misstatement and to make necessary adjustments. The auditor should also consider tailoring the nature, timing, and extent of further audited procedures so as to achieve the required level of assurance. For example, in case of test of controls, the auditor might consider extending these sample size or test an alternative control or modify related substantive procedures. Okay, so now let's talk about what are the limitations of sampling. What I would like to highlight is that the sampling technique or the sampling approach do not replace or reduce the judgment of the auditor. In fact, the standard on auditing 530, it is a principle-based standard. It gives enough flexibility to to the auditor to exercise its professional skepticism and professional judgment, right from framing the sampling plan to identification of samples to identification of a sampling method. So there is a possibility of judgment in each and every step. So the only because there is a sampling technique which the auditor has decided to follow, that doesn't at all replace the judgment of the auditor. What is also important is that it is what is important is to match the type of sample needed for the type of analysis is required. So for example, if realization of trade receivables subsequent to the year end is obviously not a correct way to verify sales cutoff. So let's say the auditor intends to verify the sales cutoff. The auditor should ensure that the samples that is being picked up is actually related to the entire population. In our example, verification of sales cutoff cannot be mitigated through checking of realization of trade receivables, because a realization of trade receivables would lead to the existence of trade receivables, where cutoff is primarily to ensure completeness of revenue. Most importantly, if the quality of the underlying data is poor, then the outcome of this sample is also expected to be unreliable. So if I can reiterate, the auditor should check the quality of information from which sample is to be drawn. If the quality is not is poor, then the sampling results may not be reliable. Okay, so here before we wrap up, the slide highlights key documentation consideration and the key resources which are available to us when we are trying to evaluate the audit samples. So from a documentation consideration perspective, my take would be that the auditor should document the sample size very clearly in the audit file. When the sample size is being documented, it should be very clearly stated that the sample size is sufficient so that the audit risk has been reduced to an acceptably low level. Another important consideration could be that the documentation substantiate the sampling procedures. What I mean by this is that in the audit file, we need to state very clearly what are the audit procedures or what are those evidences that we have looked at for the particular samples. Are those sales invoices that we have looked at? Have we looked at sales order, purchase order, the recovery proceedings which we have filed with the customers? What are the procedures that I have performed on those particular samples should be clearly documented. Uh, what the documentation should also substantiate that the items for which samples are selected have been selected in an unbiased manner, and these samples selected are representative of the entire population. This, if I can reiterate again, is a very key consideration from a documentation angle, because if the samples are not selected in a unbiased manner, then obviously the outcome of the sampling procedures would not be correct. As far as the resources are concerned that have been issued by ICI, we have the standard on auditing 530, which gives the overall framework as well as detailed guidance on auditing the audit sample. In addition to that, there is an implementation guide on SA 530, which further elaborates the concepts which there in the SA 530. It again elaborates the principles through various examples and case study, which I found to be very useful when I am trying to understand a particular concept on audit sampling. In addition to that, there are also multiple choice questions that have been issued on this particular topic. So if you're facing any challenges, I would request you to consider all these resources. Okay, so that's all I had to cover. I'd be glad if there are any questions.
For deliberation on covering various aspects on the audit sampling. We have received two, three questions till now relating to the sample size as well as relating to the various methods of sampling.
Sure.
First question is how we decide the sample size?
So Anilji, as I discussed in my slides,
Yes, already you have covered.
It is again based on the judgment of the auditor and the facts of the case, but primarily on a principal basis. It is a combination of what is the risk assessment of the particular financial statement caption. Is the auditor planning to rely on internal controls? If the auditor is expecting to perform other complementary audit procedures, or the auditor is expecting to have misstatements in those financial statement caption. So a combination of all these attributes will affect my sample size. And if I can just make one more point, the factors are inversely proportionate with the number of sample size. So if I believe that the expected misstatement will be higher, then obviously the level of samples that I would need would be more.
Yes. So how much scientific is the random method of sampling? If the member is asking if he choose for the random method, so how much we can rely on it, or choosing any transaction randomly. So how much we can rely on this, and where if as per the essay prescribed. So if we are going for the random this sampling, so what is the responsibility of the auditor in that particular?
So Anilji, irrespective of the method of sampling you choose, be it random or be it monetary, be it statistical, non-statistical, the responsibility of the auditor is uniform. They have to very clearly understand and evaluate the sampling technique that I'm choosing for a particular caption is going to help me to give a particular comfort. So that I think is the primary factor. So again, these random sample or monetary sampling unit have been prescribed in the standards of auditing. They don't mandate, right, that in this particular case, this particular method can only be followed. It is again purely based on judgment of the auditor and based on the facts of which of the technique it should choose.
Yes, exactly, rightly said, sir. With modern auto tools like the data analytical tool, cache, other IT tools, etc., it is advisable to do 100% transaction checking.
So again, I think we did discuss initially also, and Babu sir also mentioned that in his opening remark. The auditing standard doesn't mandate using audit sampling, right? Nowhere, neither in the Companies Act nor in the auditing standard, it is mandatory for the auditor to follow audit sample. But yes, one of the benefits of audit sampling is that it gives significant credence or a reliability on the entire audit approach, right? It then reduces the entire efforts and cost. But yes, if the auditor, based on its judgment, believes that that he or she wants to have a higher level of comfort, then obviously he or she can verify the population to at 100% level.
And if the transaction not falling under the sample, if any transaction you are not falling under the sample, and fraud or irregularities happen in those transactions, not falling under the sample. So will the auditor be responsible in that particular case also?
So I think here there would be something mistaken where when I am defining the overall sampling plan, right? The idea of sample is to identify a potential misstatement in a much more cost efficient way, right? So when I am defining my entire sampling plan, is it that my assessment of inherent risk was incorrect, right? Is it that I have not assigned a fraud risk factor to a particular financial statement caption? Because all these attributes will only help me to identify the correct item that should be sampled, right? So to answer your question, if I make these assessment in a more reasonable and clearer way, then I don't think there is a likely possibility that I would miss out on finding out a sample which is prone to error or which is prone to fraud.
Sir, for such a wonderful deliberation, and you have justified with your deliberation, and it was a very, very lucid manner and a very detailed manner. So, on behalf of WSP of ICI, I extend my happiest thanks towards you. Thank you so much, sir. Thank you so much.
Thank you, my pleasure.
So, moving towards the next part of this VCM, that is relating to these test of control and substantive procedures. So, we are having with us CA Munish Sharma ji. So, may I request Munish Sharma ji to please kindly deliberate on the topic, sir. Over to Munish, sir.
Thank you, Anilji, so much. Thank you to the entire council members and the committee for giving me this opportunity to share my views on the topic. Anilji, please let me know if my screen is visible.
Yes, sir. Yes, it is visible, sir. Make a press 5 to make it a full screen.
Yeah. So is it fine now?
Yes, fine, sir. Yes, sir. Yes, sir. Fine.
All right. Thank you so much again, and let's start the topic 2 for the day, which is test of controls and substantive procedures. So while we have discussed in the previous session about the audit sampling, and Nilanjan has given a very detailed overview of the entire standard and what needs to be done in the sampling, we will be now covering on the test of controls and substantive procedures. So this is the broad discussion agenda for today. In test of controls, we will be discussing overview of the test of controls, how to determine which controls to test, then how to design test of controls, which are the techniques which are available for the auditor, what is the nature and extent of testing that needs to be done by the auditor, then how to perform test of controls, and at the end, what is the evaluation? How do we evaluate our results of test of controls? The second topic that we will be covering will be substantive procedures. I would say this is the bread and butter for any auditor, because that's what we do in most of the audits. We perform substantive procedures. So substantive procedures are of two categories: analytical procedures and test of details. So we will be discussing these slides as and when will come. So to give you an overview, this is the overall plan. Sources of audit evidence. Now, the main job of an auditor is to collect the audit evidences and analyze those audit evidences, and based on those, opine on the financial position of the company, whether there are any material misstatements in the financial statements, or whether the financial statements are giving true and fair view of the company's financial position. Now, audit evidences are of two categories: test of controls and substantive procedures. And substantive procedures are further broken down into two components. One is analytical procedures and test of details. Let's understand what test of controls are. Now, test of controls is an audit procedure which is done by the auditor to obtain audit evidence about whether there are any misstatements in the financial statements. Now, when do we use test of controls? Test of controls are normally used in an integrated audit. Now, integrated audit is an audit when the auditor has to opine on the financial controls of the company and on the financial position of the company. or typically you can say in a ICFR scenario where auditor has to opine on the internal controls on the financial reporting. There's another aspect when the controls can be used is when the auditor really wants to rely on the controls and they want to reduce their substantive audit procedures. Now, para 110 of ICFR guidance note says that auditor should test the operating effectiveness of the controls by determining whether the controls are operating and designed effectively. Now, what do we mean by operating effectiveness and design effectiveness is that the management designs the controls for respective processes. So like management will have revenue as a process where management will define that, these are the processes, these are the controls for revenue. Now, the auditor job is to first understand the process and evaluate whether the designing of the controls is appropriate or not. And once the auditor is, satisfied about the designing of the controls, that relevant controls have been designed by the management, the second step comes as testing the operating effectiveness of those controls. What do we mean by operating effectiveness is that the control is operating as per the desired objective. So suppose we had an objective for a particular control is to stop any pilferage in the company. So that was the objective. And the control, whether that control is able to stop that pilferage or not, that is the evaluation that auditor needs to do by testing that control. So in our subsequent slides, we will see how that testing is to be done. Now, SA 330 says that controls can be tested for operating effectiveness if and only if there's an expectation that the controls are operating effectively. What does this mean is that suppose you have a client where promoter has a lot of influence on the operations of the company, and promoter can actually influence the controls. So in that scenario, there's an expectation that controls, though may be devised, management is in a position to override those controls. So in such a scenario, your expectation will be low in terms of testing the controls. So auditor may or may not decide to test those controls, and they may use other auditing procedures to derive the audit evidence. The second scenario could be where substantive procedures alone cannot provide a sufficient appropriate audit evidence. Now, what could be an example of this? Let's take example of a telecom company. So in a telecom company, what is revenue? Revenue is the all call data which is being captured. So as an auditor, if he does sampling for say 100 invoices or 200 invoices or 5,000 invoices, even after testing so many invoices, the auditor cannot conclude whether the revenue is appropriately recorded in the books of accounts. He need to have some additional procedures in order to get a comfort that the revenue has been appropriately recorded in the books of accounts. So what auditor can do, he can test the controls around the ITGC, the information system of revenue, test how revenue is being recorded. And once the auditor is satisfied about the controls which are built in by the management over revenue, he can add on some substantive procedures to conclude the appropriateness of revenue being booked in the financial statements. So our coverage in subsequent slides will focus on how to determine which control to test, how to design TOCs, how to perform TOCs, what sampling techniques can be used, and how to evaluate results of TOC. Now let's take them one by one. The first and foremost job of an auditor in test of controls is identification of controls. So auditor first need to identify which are the controls which are prevalent, which are there, which has been devised by the management in various captions of the financial statements. So this is typically done using a risk assessment approach, where in the planning phase, the auditor identifies the areas which are more suspected to misstatement. So these areas could be revenue, cash and bank, it could be inventories, it could be transactions with related parties and likes of those. So once the auditor has identified which are the main areas which could be suspected of material misstatement, The second process comes understand the process. So like we have, let's take one example of revenue or cash in bank. So auditor need to understand what is the process behind revenue recognition devised by the company. And in this process, what are the controls which management has built in? So these controls could be automated controls, which we call IT-enabled controls, or these could be manual controls, or it could be IT-enabled manual controls. So there could be three categories of controls. So auditor need to understand what controls have been devised by the management. Once he gets the understanding, he needs to select the key controls and test those controls for design and operating effectiveness. So that's the nutshell of how the identification of controls is done. So now, let's take some examples. So suppose let's take revenue of a telecom service provider. So revenue recognition for a telecom company is highly dependent on the IT environment, because all the calls data, all the information which is sitting in the IT system is actually converting into revenue and is being recorded in the books as a revenue. And there's a high volume of transactions. Complexity level is very high, and test of details is not sufficient to get a comfort. So auditor will be identifying both IT controls and manual controls in a telecom environment and accordingly do the testing. Let's take another example of cash collection at toll plaza. So at a toll plaza, every car which is passing by is actually generating revenue for the company. And the volume is so high, just imagine by the scan of the barcode and by the camera, the revenue is recognized in the books of accounts. The money is deducted from your Paytm account, gets credited to the company's bank account. And at the end of the day, the entire revenue and collection gets posted in the books of accounts. So here for an auditor, it is very difficult to perform substantive procedures only and get a comfort on the appropriateness of cash collections or the revenue recognized during the year. So again, in this environment also, auditor need to understand what the IT environment is, understand what controls management has put in. Examples could be like who has the cash custody, whether company is doing a daily cash reconciliation, whether cash is daily deposited in the banks of accounts or not, what are the overall controls. So once the overall understanding is there, then auditor can test the relevant controls. Let's take another example, inventories of retail stores. So in case of retail stores, the inventory is very high moving. So let's take example of Reliance, which has multiple stores across India. And there also, if an auditor need to assess what is the inventory level, whether it's properly managed or not, whether company has proper controls around that. So auditor need to understand the entire system, whether there's any perpetual stock count, are there any barcodes in the system, whether management does any surprise checks, what is the inventory management by the company. So once he get an understanding, then he can, test the relevant key controls. And likewise, in case of a BPO environment where employee cost is very high, and there are multiple employees. So there could be a risk that about the existence of employees, whether there's appointment formalities and removal process, what is going on, whether salary increase have been properly captured in the books of accounts, what controls have been devised by the management around these key processes. So that's more of identification of controls. The second step comes is what techniques auditor has. So in the previous slide, we have discussed that the auditor has now identified which are the key controls to be tested. Now the question comes how to test those controls. Now there are techniques which are given, which is observation, inquiry, reperformance, inspection, examination, and other procedures. So let's understand these one by one. See, observation is nothing more than just observing a control being processed by the company. So classic example could be an accountant who is reviewing the payment list and cross-checking the payments from the invoices. So if an auditor observes that, the accountant is doing the job and he's signing and he's counter-signing the receipts, he can ensure that, by observing that this control is existing. Please mind it that only observation cannot give you a desired benefit, desired comfort. You need to have some documentation or some additional procedures whereby you can conclude that the control is operating effectively. Other example could be, other technique could be inquiry. See, auditor can inquire from the relevant people. So let's take one example that debtors aging report is being reviewed by the finance controller. So auditor need to inquire from the finance controller that how frequently that review is being done. Are there any sign-offs by the finance controller when the aging report is reviewed by them? Are there any follow-ups emails being sent by the finance controller for the debtors aging report? The third procedure can be reperformance. So reperformance is testing of a control using an incorrect transaction to ascertain that the control functions as expected. So let's take an example of a dummy sales invoice. So suppose the company has a control that a sales invoice cannot be created without a valid purchase order. So what auditor can do, they can put a dummy sales invoice in the system and try to pass that in the accounting system. In case the system asks for a valid purchase order, that means that control is still functioning in the IT environment, and accordingly auditor can document in their books of accounts. The last step is inspection or examination. So this is the legacy what auditors have been doing. They've been inspecting their clients, the client personnel, and examining the evidence. So one example could be you review the records and documents, copies of GRN, invoices, check the payments, whether this has been done as per the authority, and understand that, you know, what controls management has explained you that these controls are there, are actually functional and are operative. There could be other procedures which could be, you know, a combination of an inquiry and an inspection, or an inquiry or a reperformance, or and likes of those. Now let us understand the nature and extent of testing to be done. Now controls are divided into three broad categories. One is the automated controls, the manual controls, and computer dependent manual controls. So when we say nature of these controls, the automated controls are computer-based controls, and they remain same throughout the year unless they are changed. So if you have programmed the SAP environment during the year to do FIFO valuation of inventories, so system will continue to do the same valuation of inventories using the same program, same logic throughout the year, unless somebody does a human intervention or manually change or does a reprogramming in the system. So automated controls can be tested once only during the year, and doesn't need to have a sampling approach for automated controls. Manual controls are dependent on person, and these are independent from the computer. So these manual controls require judgment, estimates, and human intervention. And these manual controls change from time to time and person to person. Suppose an accountant who's approving all the travel bills of a company. Suppose he's in a good mood, maybe he will approve all the expenses, travel expenses, and someday he's not in a good mood, so probably he will deduct or do a very minute review of the bills and disapprove. So what we are seeing is that though the control is there, but that is dependent on the mood of the person who's approving or disapproving those. So third category is computer dependent manual controls. So there are certain controls which are dependent on computer. One classic example can be the finance controller reviews the inventory aging report, which is drawn from the SAP. So now if the report from SAP is wrong, the control again fails because whatever review is being done by the finance controller on the aging report cannot be relied upon, and the entire control is bound to fail. We move to the extent of TOC testing. So for manual controls, these controls are not consistent and may change from person to person. So here, typically we use sampling of the population. the sampling is done to avoid any bias and give each and every sample a fair chance of getting picked. So sampling, you can use the same technique what we have understood in the previous session by Nilanjan. So we can use the same sampling techniques to find out our samples for test of controls. Now, automated controls can be tested by IT experts only. We as an auditor are not technically, competent enough to check those IT controls. So we typically use a CAT approach and use the IT experts for getting a comfort on these controls. Like I mentioned in the previous slide, that automated controls are only tested once. So one sample is enough to test the automated controls unless these controls are not changed during the year. Now let us discuss timing of test of controls. So tests of controls can be performed during the interim testing, or these can be performed at the year-end testing. Now, there's a special consideration for ITGC controls, that ITGC controls needs to be tested during the financial year only. So if somebody is testing these ITGC controls post year-end, then it is very difficult to establish the fact that these controls were actually operating effectively during the financial year. While other manual controls can be tested subsequent to year-end, considering you have the trail, the evidence, the supporting documents are there. So these can be tested subsequent to year-end, but ITGC controls can only be tested during the financial year and not post that. Now let's see how to design controls for testing. Sampling, I will not cover in more detail because the concept remains the same what we have discussed in the previous slide. There could be some practical scenarios where, when you do not have the audit evidence in electronic form. So the typical example that we have taken for the telecom service provider, where the entire revenue data is not sitting in a physical form. So it's not like a manufacturing company where you can, count the number of cement bags which are there. So this entire system, this entire data for revenue is being recorded into a IT system. So here you need to have, the IT experts who can help you to conclude on the effectiveness of the IT environment. So typically we have two scenarios. One is the ITGC is effective and ITGC is ineffective. So what I mean by ITGC effective is that the overall IT environment is effective and auditor can rely on the reports which are being generated by the IT system. When I say ITGC is ineffective, it means that the integrity of the system has been compromised by the management, and there have been some changes which are done in the backend which cannot be traced by the auditor, and hence auditor cannot rely on the IT environment. In such cases, when we have an ITGC ineffective, the auditor need to perform some alternate procedure, which is test of details or other audit evidences that needs to perform to get a comfort on the overall IT environment and the overall financial statements. Now, one typical example which I can share with you in case of a ITGC ineffective is, suppose I have a SAP environment which is ineffective and auditor is using the aging report of debtors from the system. So in case auditor, in this case, the auditor need to perform a re-performance check of the aging report, which means that auditor needs to reconstruct the aging report which is being taken out from the system. And once he is satisfied that the aging report taken from the system and the aging report which has been calculated by the auditor is same, then he can actually rely on that report. In case of ITGC ineffective, auditor cannot blindly rely on the reports which are taken from the system. Let's take example of multiple locations. So a client may have multiple locations or may apply same controls to all locations. So it is very common for companies to have multiple factories, multiple subsidiaries, depots or warehouses, where the systems, the controls are same. So before testing controls at a multiple location, auditor need to ensure that the performance of control to be tested is consistent, which means that the controls which we are planning to test are consistently applied by the management at all locations. And in case the auditor concludes that the application of controls are not consistent on all the locations, then auditor needs to have then auditor need to consider each location as a separate population and accordingly do sampling for each location based on the risk associated in those locations. Now let us understand the testing approach and when this testing is being done. Now, controls are so before in the planning stage, the auditor gets an understanding of the controls. So based on the risk assessment, auditor assess the risk which is associated in the financials and try to get an overall comfort on the operating effectiveness of the controls. Now, at the planning stage, auditor may indicate that these controls are operating effectively, or he may not able to conclude. Now, how this is being done is auditor typically understand the process, what management has over a particular process, and performs a walkthrough of the entire transaction to understand what controls are there. Now, in order to test those controls, the auditor actually draws samples and conclude whether they can rely on these controls or they cannot rely on these controls. So in case the auditor concludes that these controls can be relied upon, the substantive work of the auditor reduces. And in case where the auditor says that these cannot be relied, so probably they need to perform some additional procedures. Now, in performing design effectiveness, this is a step-by-step procedure how actually auditor evaluates the design effectiveness of a particular transaction. Now, first step is who's the owner of the control. So auditor need to understand who actually owns that control, whether that person is competent enough to own that control or not. Are there any segregation of duties? Suppose the same person has been assigned to approve the invoices and pay the invoices. So in this case, there's a lack of segregation of duties and the owner of the control is inappropriate. So whatever in this scenario, the design effectiveness is bound to fail because of lack of segregation of duties. The second step comes as description of the process flow. So I need to understand what the entire process is, where these controls are sitting. The third step is properly designed in the control meeting, control objectives. Auditor need to understand the control which has been designed, whether the control is meeting the objectives or not. In case a control is not meeting the objectives for which it was made, then there's a design failure of that of the entire control. The next step comes as the auditor documents the deficiencies if they have observed. Suppose the auditor performs test of controls and they conclude that certain controls are actually not effective as they were intended to be. So auditor will say that there's a deficiency in the system, and accordingly he will conclude all the deficiencies into either a material weakness, a significant deficiency, or an internal control deficiency. So in a subsequent slide, we'll be talking about what these material weakness, significant deficiencies, and control deficiencies are. The last step is prepare a remediation plan. So the remediation plan could be the auditor can think of additional procedures in case there are certain material weaknesses or significant deficiencies. So they can look for an alternative plan. They can do a communication with those charged with governance, the management, and communicate their findings to the management. The last step here comes as evaluation of results of the test of controls. And how do we conclude? Now, auditor must evaluate the severity of each deficiency and whether the individually or in combination are significant deficiency or material weaknesses. So what does that mean? Whatever deficiencies auditor has collated during the test of controls, so these deficiencies will be collated and will be bucketed into either a deficiency, material weakness, or significant deficiency. Now, the guidance note on ICFR describes deficiency as a deficiency exists when in the design or operations of a control does not allow management or employees in normal course of performing their assigned functions to prevent or detect misstatement. So the control is not able to prevent or detect a misstatement in the financial statements on a timely manner. So this will lead to a deficiency in overall control environment. Material weakness is a deficiency or a combination of deficiencies in the internal financial controls. Such there's a reasonable possibility that the material misstatement of the company's annual or interim financial statement will not prevent or detect on a timely manner, which means that yes, there's a deficiency in the system and there could be a material misstatement in the company's financial statements, and that misstatement will not be prevented or detected on a timely manner. So there could be some indicators of frauds by the control deficiencies. There could be some errors in the previous year financial statements, which may again, throw a material weakness in the overall financial FSCP of the company. There could be some misstatement in the current year financial statements, which may indicate that there's an overall deficiency or a material weakness in the financial statement preparation process of the company. The last is the significant deficiency. So significant deficiency is a deficiency which, as per the auditor belief, is important enough to be communicated to those charged with governance. It could be audit committees, it could be directors, it could be the management, it could be promoters of the company. And this may lead to a severe misstatement in the financial statements. So once the categorization has been done between deficiency, material weakness, and significant deficiency, auditor need to conclude what is the overall comfort which has been driven by performing these tests of controls. Are they happy about the controls? Are they not happy? Can auditor issue a clean opinion on the financial statement based on the testing they have done? So that evaluation is a very judgmental process by the auditor, and they need to evaluate that what is the overall outcome of our testing. And accordingly, they should, either do a communication with the management or opine on the overall financial statements and internal controls. We come to the second section, which is substantive procedures, which is substantive analytical procedures and substantive test of details. Now, substantive analytical procedures are techniques used by the audit team to study probable relationship between the financial and non-financial and internal and external data. So typically what auditor is doing in substantive analytical procedures is he is trying to correlate certain financial and non-financial data and try to figure out whether the financial statements, is there any material misstatement, is there any error, or is there any misappropriation in the financial statement. So some examples of analytical procedures could be variance analysis on a year-to-year basis, where we compare the current year financial numbers with the previous year financial numbers and figure out what is the variations and identify reasons. Compare budgets with the actuals. That's the second way. Benchmarking companies' data with the industry. So typically, suppose let's say industry is doing very well and is growing at the rate of 20%, while the company is not able to grow at the rate of 20%. So when I'll do a benchmarking of the company's performance with the industry, so I'll figure out that is there something wrong with the company? Are there any things which are not apparent in the financial statements which auditor need to probe in? The fourth example is develop estimates and comparison with actuals. So auditor can develop certain estimates. He can compare those estimates with the actual performance of the company and see what differences are there. Then study relationship between financial and non-financial data. So this analytical procedures can be used in all the stages of an audit, which is risk assessment procedure, which is the planning phase, the substantive procedures, which is the execution stage, and the concluding procedure, which is the conclusion stage. So let us see what analytical procedures can help in the risk assessment process. So in the risk assessment process, typically these analytical procedures help auditor in getting an overall understanding of the business, the financial position of the company, risk identification. It also helps in identifying any unusual transaction during the year, which can also indicate a fraud or a misappropriation in the financial statements, or understand period end values and ratios. So certain examples which can be used in the planning phase is GP ratio analysis, cost of sales ratio analysis, inventory ratios, trend analysis. So an auditor can use these ratios and ask intelligent questions to the management and understand what is happening in the company. The second is substantive procedures. So ratios and analytical procedures provide additional evidence to the auditors while performing the substantive procedures. So an example could be comparing the sale volume with the production capacity. Suppose the company has a production capacity of 1,000 metric ton, while sales during the year is 2,000 metric ton. So just by comparing the sales volume during the year with the production capacity, the auditor can identify any fraudulent sales in the which have taken place during the year. Auditor can also do a month-on-month sales analysis and depict any spikes in the sales during the year or any low months where sales have not been booked. It can also indicate a trend where sales have been pushed on the last day of the month, or maybe last month entire sales have been booked. So this comparison can give you a realistic picture of what's happening in the company. Another example could be input-output ratios. See, auditor can see what was the input, what is the output, are these ratios reasonable, are these ratios consistent with the industry or consistent with the previous years. So again, these ratios and analytical procedures throw a mismatch or throw a number to the auditor, which can further be probed with the management, and auditor can devise procedures to mitigate those things. In the concluding procedures, these analytical procedures provide evidence at the closure of the audit. So there could be some variance analysis which auditor does, or auditor can compare the MIS with the actual profits, the profit books in the MIS versus the actual profits, the ratio analysis. It can also indicate any going concern or any impairment trends which are there, which can be tested using the analytical procedures. Now, let us understand how to perform these analytical procedures. So typically, it's a 4-step approach how to perform an analytical procedure. Step 1 is develop an expectation. Step 2 is identify what differences are. Step 3 is investigate those differences. And step 4 is evaluate what is the overall results of those analytical procedures. So let's understand these 4 stages one by one. So in the first stage, the auditor develops an independent expectation, and this expectation can be developed using trend analysis or ratio analysis. So trend analysis, auditor can compare sales in the industry versus the sales in the company. So is there a trend what industry is following and what the company is following? What are the consumption patterns in the industry versus the consumption pattern by the company? Is the company's consumption pattern is very low as compared to the industry, or is it very high? Or they can also see a trend of from the previous years, that how the consumption pattern is changing from year to year, and ask questions, the probing questions from the management, and do the testing. Other way of developing expectation is ratio analysis. So ratio analysis is again a very good tool where certain key ratios can be identified, and these ratios can be tested with the previous year ratios. Suppose a debtors turnover ratio. So auditor can compare the debtors turnover ratio of the current year with the previous year and check whether it has increased or decreased, and what would be the sales trend in the company, or what could be the collection trends in the company. What could be the creditors turnover ratio, liquidity ratios, current ratios? See, all these ratios can be used to develop an expectation of our analytical procedures. The second step is identification. So we have developed expectation in the step one. Now we compare the expectation with the actual values. Suppose our expectation is that sales have increased by 5% in the current year, whereas the actual sales have increased by more than 5%, or it could be lower than 5%. So here what I'm doing is I am comparing my expectation with the actual results. Another example can be finance cost was expected to increase because company has taken borrowings during the current year. But when you see the financial statements, the finance cost is actually going down. So you can actually inquire from the management that despite taking new loans, why finance cost is going down. Or it could be the payroll cost is expected to increase because there were good increments in the company and promotions. While in the financials, the payroll cost is going down. So what could be the possible reasons for decrease in the payroll cost? The third step is these differences are investigated by the auditor. So how these differences are investigated? This is either through discussion with the management or key management persons. Auditor can also review the board reports and minutes. They can also check their expectation for any bias or errors. So it could also be possible that while developing the expectation in the step one, the auditor has done some errors or there were some biases. So that auditor also needs to check their expectations. And they can also check the expectations. They can also inquire from the independent persons. Any person who's outside the organization or outside the finance function, they can also get some, evidences, or they can also get some insights of what are the trends, why the expectations are not matching with the financial numbers. The fourth step is a conclusion is drawn by the auditors based on the understanding they have got from the management, and based on the conclusion they can actually plan their audit procedures. Suppose auditors identified that sales have been heavily booked in the month of March. So auditor can actually test the cutoff. They can actually plan testing the cutoff, or they can actually see to whom these sales have been made, whether these sales are genuine sales or these are fraudulent sales, and they can accordingly devise their audit plan based on the inputs they have received from the analytical procedures. Now we'll discuss about the test of details. Now, test of details is, I would say, we all are well aware of what test of details are. We typically perform our audit procedures based on substantive audit procedures. So these test of details can be developed based on the assertion which the auditor wants to take a comfort. Suppose the auditor wants to take comfort on the existence of debtors. See, then there can be specific test of details which can be developed, like sending confirmations to the customers, or sending specific inquiries to the customers, or testing the subsequent collections just to get a comfort over the existence of these customers. So typically test of details are procedures which are developed by the audit team based on the risk assessment process in the planning phase, and the extent of reliance on the test of controls. So there's a play between what kind of test of controls an auditor will perform with versus the overall conclusion from the test of controls. So if the conclusion from the test of control is that auditor can rely on these controls, the auditor will tend to have less complex or straightforward test of details. While if the test of controls have failed, the auditor have to perform more stringent and more elaborative test of details in order to get a comfort over the balances. Now, there are certain methods which are used for test of details. The first one is the sampling approach. So in the sampling approach, only selected items are tested. Now, these samples are representative of the population, and hence the results which you derive from the sampling can be applied to the entire population. We have discussed in the previous presentation with Nilanjan that there was an error ranging from 10 to 15%. So that error can be extrapolated to the entire population to get the overall error in the sample. The other approach can be 100% examination. So 100% examination is done when the population is small and the sampling risk is high. So typically when you have a very complex environment and it is driven by IT, so you can take use of your IT's team and take a comfort over the population. Test of high value items. So this is also a method of testing where only high value items are tested. So typically what auditor does is they split the data into two parts. One is the high value data and the low value data. And on the high value data, detailed procedures are performed. And for the non-high value items, other procedures are performed. So what auditor is actually doing is actually mitigating its risk over the high value ticket items. Then there could be examination of key items. So auditor can actually examine certain key aspects based on the qualitative nature or items which as per the auditor are prone to errors. Now, typical example could be related party transactions, where auditor wants to examine and test the related party transactions or any other transaction which auditor believes are unusual in nature. So these methods can be used for performing test of details. Now, one or more method can be used for testing one or more captions. For example, auditor can perform 100% verification of related party balances, and other balances can be tested on a sample basis only. Now, let us discuss some examples of test of details. First is interest expense. So if auditor have to perform procedures to test interest expense, so auditor can take the interest rate from the loan agreement and apply the interest rate to the outstanding loan and see what is the overall interest expense. So here auditor can also develop an independent expectation of what could be the interest expense and compare the actuals with the expectation. Investment income, again, interest rates or the yield on the investments can be applied over the investment value, and auditor can derive the value of the interest income. Lease expense, typically you can multiply the per month rent with 12 to derive the what is the overall value of lease expense recognized in the profit and loss account. And likewise, auditor can develop various auditing procedures, various substantive procedures to test various assertions. Let's take example of existence for creditors. So in case auditor have to test the existence of creditors, they can float samples on a sample basis. Rights and obligations on the creditors, they can review on a sample basis the creditor invoices and check whether these invoices belongs to the company or not. Completeness of creditor balances, auditor can review payments made after the year end and ensure those which should have been included in the creditors. This is typically called search for unrecorded liabilities, where subsequent to year end, auditor actually tests balance payments which are above a particular threshold just to see whether these payments have been provided in the books of accounts or not. Accuracy, the creditor was recorded at the current amount or not. Auditor can check the sample creditor balances and transaction. They can test the invoices to ensure the accuracy of creditors being reported in the books of accounts. Valuation, in case of inventories, auditor can check on a sample basis the valuation of inventory, either FIFO basis or weighted average basis. They can also check the cost or NRV comparison. They can check whether the inventories are to be valued at cost or NRV. They can also have some audit procedures to test the overhead loading on the inventories done by the management during the year. So based on whatever assertion auditor has concluded which requires to be tested, the auditor can develop test of details to mitigate those particular risks or the assertions. I think that's it for from my side. I'm through with the presentation. Happy to take questions if you have any. Anilji?
Can you hear me, sir? Can you hear me?
Yeah, I can hear you.
Sir, there are 2-3 questions, sir, relating to this.
Yeah.
Yes, sir. So would the same approach be used if we talk about the sampling? Would the same approach be used if management were to do the test of control and this working is presented to the statutory auditor to support management assertion?
Sorry, can you come again?
The question is there any difference between CTT and threshold limit? If yes, and if the same approach is to be used if management were to do the test of control and this working is presented to the statutory auditor to support management assertion.
So I think from a sampling perspective, there is no change in from a test of details or test of controls. The standard on sampling can be used for both TODs and TOCs.
And again, relating to your presentation, one member is asking the sample size. Is a sample of the size covering around 50% of the population in that particular account that's sufficient as a thumb rule?
No, in test of controls, like we have discussed in the previous slide, in case of automated controls, only one sample needs to be tested. And as a typical threshold, so if you go in the guidance note of ICFR, so based on the frequency of controls, the samples can be identified. So suppose a control is operating on a daily basis, on a monthly basis, and accordingly you can find out samples, number of samples to be tested. As a thumb rule, a control can be tested 25 times. So 25 is the maximum sample which can be used for testing.
Okay. And control can be tested both electronically or manually?
So the automated controls or the IT controls have to be tested electronically only, using the help of the IT experts, and other manual controls have been tested. These cannot be tested electronically. These have to be tested manually. While auditor can, take screenshots from the SAP, or they can, see the evidences online, but while doing the documentation, they need to conclude how they have seen the evidences. So, I mean, can be done either ways.
And is it okay to use the test of control when management is not up to the mark? Management is on not talented, or it is on the poor side?
No, then it is not advisable to perform test of controls where auditor reasonably believes that the controls are not sound, or management is not able to give a good control environment. Even if the auditor still wants to test those controls, they will be incurring extra cost, and they'll be wasting their time.
Yes. One last question, Manish sir. Is regression analysis also covered into this test of control? If yes, when to the regression analysis is to be applied?
No, I am not aware if regression analysis is covered in test of controls.
Fine, sir. So these were the questions we have received till now. Thank you so much, sir. And it was again a wonderful deliberation from your side. And thank you so much for sparing your valuable. Once again, thank you so much for acceding to our request on a very, very, very shorter notice this time also. So thank you so much. And you have also justified with your presentation. I have gained a lot through your deliberation. Hope our members have also gained. And it was wonderful and detailed deliberation, sir. Thank you so much on behalf of WSP of ICI. Again, I extend my heartiest thanks. Thank you so much.
Thank you so much, sir. Thank you.
Thank you.